In a nervous market, investors are flocking to what are known as buffer ETFs. Let's get more from Tim Urbanowicz, Chief Investment Strategist at Innovator Capital Management. Tim, thanks very much indeed for joining us. Just to remind the viewers, so buffer ETFs in theory offer some downside protection. I see one example at BMO says they'll protect you for the first 15% of a market decline. I guess that appeals to investors in an environment like this.
It does. And Andrew, I think it's all about really narrowing the range of outcomes right now, really focusing on certainty over uncertainty. And that's really what buffers provide. It's obviously a trade-off here with the strategies that you just mentioned with a 15% buffer. You take an example like PJAN. Over the course of the full calendar year, investors can know that if the market goes down anywhere from 0 to 15%, they're going to be protected against those losses. They would take on any losses beyond that 15% mark. And then on the upside, they would be able to capitalize on the S&P 500 ETF return up to the first roughly 12% of gains. So it's really for those investors that don't want to take on the full risk of the equity market, but still want to generate equity-like returns in their portfolio.
But there is a limit to the upside typically?
There is. So the trade-off comes in the form of a cap, and there's many different buffered ETFs in the marketplace. This is a category that has exploded to about $50 billion plus in the U.S. And there's really the cap is all dependent on the level of protection that you're getting. So the 15% buffer, which has been the most popular in the U.S., those caps are right around 12 to 13% right now. Innovator also offers strategies that have 100% buffer. So really principal protection outside of the expense ratio, those caps over a 1-year period are in the 7 to 8% range. So it really allows investors to pick and choose what is their risk profile, how much upside do they want to forego, knowing that if the market does fall, this is the level of downside protection that they have in place.
I know I'm not talking about buffer ETFs, but I know with similar products in the past that aim to limit your losses. In many cases, you're better off just owning stocks, aren't you? Because there's costs. There's cost with any kind of protection.
There's always a cost to protection, and if you're an investor that has a 30-year time horizon, grabbing and holding a low-cost S&P 500 strategy is a great way to go about it. But really what we see with these strategies are a couple different applications. One, they're very heavily utilized in the retiree, pre-retiree community where those investors, they don't have that time horizon. They can't stomach the full loss of the equity market. And instead of taking their portfolio from a 60-40 maybe down to a 30 stock, 70 bond mix, these funds really allow them to maintain their equity exposure, maintain that growth tilt, while still making sure that they're in full control of the risk that they're taking on in the portfolio. And Andrew, we also have a lot of advisors, a very good chunk, that really use these as either a complement or a replacement to their fixed income holdings. There's a lot of advantages here in the U.S. A big one is the tax efficiency here. You're able to take those low-risk dollars, make them more tax efficient by deferring gains. You're not just paying ordinary income every time a distribution is made. You can defer these until sold. And also you're taking those low-risk dollars and you're tying them to the upside of the equity market. So you really are able, relative to those other instruments, again, cash, savings accounts, CDs, bonds, are able to get more upside potential. And I think that, paired with the certainty, really has driven the growth in this asset class in the U.S.
Let's look at the broader market, if that's okay. You say for the first time in 3 years, you have reasonable confidence that inflation and interest rates are likely to come down.
Yeah, this is a big shift, and I think a lot of this has to do with some of the actions that we're seeing from the Trump administration. And if you look at really the root cause of inflation over the last several years, I think a lot of it has to do with the spending, the excessive spending that we're seeing coming out of Washington. In an environment where we have had unemployment that is incredibly low, hovering around 4%, we've been seeing the government run a recessionary level deficit as a percentage of GDP in the 5 to 7% range. It's hard to get inflation under control when you have that type of spending. With all the cuts that we're seeing, yes, they're painful. It's tough to see people losing their job, but at the end of the day, bringing that spending in We also see a lot of those layoffs where those employees are going to be reallocated to the public sector or the private sector, rather. That has the ability to really rebalance the labor market, and we think help bring cost and thus interest rates down over the next year or 2 years.
Maybe we'll put up a 5-year chart for the U.S. 10-year bond yield. You reckon that the Trump administration is willing to see pain in the economy to achieve its goals, including lower borrowing costs?
I do think that, and if you look at the historical trends of inflation, anytime we get above 5%, Andrew, you typically don't see it coming back down to 2%. In fact, you've never seen it come back down to 2% without some type of recessionary hit to the labor market. So if we want to get longer term interest rates down, intermediate term interest rates down, we have to see some economic pain here. I think the Trump administration recognizes that. They're going to be okay with it. And quite frankly, I think the sooner that happens, the more they're going to be satisfied, because it's easier to point back and say, hey, this is an economy that we inherited, and really let this thing rip in the last 2 to 3 years of the administration.
Let's put up a 5-year chart for the S&P 500. Do you think we'll have another decent year this year? Maybe not as great, I know, as 2023, 2024.
Well, yeah, it's hard to compete with 2023 and 2024. One of the interesting things that we've been looking at here, and it looks like we're going to finish this quarter in the down 0 to -5 range. What we look at is when we typically see the S&P 500 finish Q1 in that range, you tend to see a flat return the rest of the year. And I wouldn't be surprised if you did see something like that. I do think tariffs are going to be a continued source of volatility here in the short run. We are going to see some of that pain. But overall, we still think, the economy is coming off such a hot streak. It has a high starting point. Even if you see some softening, it wouldn't be surprised if you still saw the S&P 500 eke out a small gain. I do think one of the things that has changed from our outlook in the beginning of the year here is clearly we've had several catalysts that have dented that extreme sentiment and brought valuations down with them. So I don't think you're going to see this boost that we saw in 2023 and 2024 from valuations moving higher. You just can't count on that anymore.
Thank you very much indeed for joining us, Tim.
Great to be with you, Andrew.
Tim Urbanowicz, Chief Investment Strategist.